Welcome to your weekly market update. First, I'll talk about interest rates really quick. As you can see, the recovery continues. Interest rates are headed lower. It's been a great 2 week run for lower rates. You're starting to see higher 6% interest rates. These were mid 7% interest rates. So wonderful growth. Right here, December 9th, you can see it was just one day, was the second lowest interest rate of the year. This is how quickly these things change. People think that rates stay for like several days or weeks or months. Yes, the direction of them do, but the outliers last for sometimes less than 2 hours. So you need to work with a professional that understands these markets. Most loan officers do not. I have a finance degree. I actually went to college for this. I trade these markets and have for 22 years now. I always tell people I've lost hundreds of thousands of dollars in these markets to make millions. And I have monitored and locked over 6,000 people in my career. So I understand these markets like the back of my hand, thanks to a mentor that has taught me this. Someone I have a personal relationship with, someone I have paid to subscribe to their services for over 20 years. And I wanted to read a letter that he just wrote to President Trump because it's so important when it comes to the housing market. And let me share it with you. His name's Barry Habib. You can see him on CNBC Squawk Box. He runs a service called Mortgage Bond Highway. I'm a big believer in it. Barry's a great guy, someone I would consider a friend, a mentor, a coach. I've had him serve many different roles, and I want to just share the letter he wrote to President Trump because it's so true and accurate. And I want you to be on the lookout for this. The problem is if you're out looking at a home, you are going to struggle in getting that home and getting outbid and paying more in the price when the Fed changes their methodology of looking at inflation. So I'll just read it as he sent it to everyone that subscribes to his service. President Trump, it's always an honor to see you at Mar-a-Lago. Recently, Roger Stone suggested I share some of my thoughts with you on ways to make housing more affordable by using more updated indicative inflation metrics. I understand how important low rates are to you in our country, and I believe that the Fed can be influenced to cut rates aggressively if they understood how flawed their methodology is. And I agree with him. The Fed believes that inflation is too high. Their favorite measure of inflation, core PCE, which is the personal consumption expenditure, sits at 2.8%, much higher than the 2%. Core CPE, this is a consumer price index. This is an inflation report that the Fed looks at, is another important measure. That sits at 3.25, also much higher than their 2% target. So the Fed wants to get their target down to 2% on both of these indices. But the constant jawboning about needing to get inflation under control has caused concerns in the bond market. The bond market is what determines interest rates, not the Fed. It's what traders trade the bond market at. So the problem is the Fed's methodology is flawed and antiquated. The largest part of core inflation calculation is shelter. As you know, this measures actual rents as well as the imputed guesswork of what an owner would charge rent for their home, not home prices or mortgage payment. While this type of data gathering can be improved, the major problem is the lag. The lag, the lag. That's the big problem in the data compared to what is happening in real time. And if you think about a lease, it's a year lease. So you write it, you sit in it for a year typically, and nothing changes for that year. It's flawed that they only look at that. Shelter is the largest component in both readings, and it accounts for 18% of the core PCE and a whopping 46% of the CPI. So the biggest sector has the most flawed data. Huh. Probably an issue, right? Why did they keep interest rates too low for too long? Because of this, right? Why have they kept interest rates too high for too long? Flawed data, right? So PCE shelter 4.8% year over year as of November. CPI shelter 4.6 year over year. So check this out. Both of these readings account for the lion's share of the perceived inflation problems and also are a major contrast to real-time data. So the real-time data tells the truth. There are multiple readily available, reliable sources, third parties, non-government entities like CoreLogic, showing that rents on a blended basis between new and renewals are actually up just 1.5%. So not 4.8%, 1.5, less than half, which gets them to their 2% target if they would look at the data correctly. Other sources like apartment lists and realtor.coms, third party services that actually do this for a living, which meant like, why would we look at that, right? Um, Other sources like apartment lists and realtors, which measure new rents, can be blended with sources like Zillow, which measures renewal rents to show an identical result of a 1.5 annual increase. This is a good data that tells us that both PCE and CPI are dramatically overstating inflation. Eventually, these numbers will catch up, but it's taken too long. It shouldn't take this long, right? And this is what Barry says, but it will take the better part of another year to do so. I will offer an explanation below on the current flawed methodology and how it has kept interest rates both higher and lower longer than they should have been, causing boom and bust cycles. But first, let's take a look at how the Fed, through miscalculation, was complicit in causing the inflation problem that we have experienced. Back in 2022, anyone with common sense or who had a firsthand grocery shopping experience would have known that inflation was rising quickly. But the Fed kept fueling the flames of inflation with QE. That's quantitative easing. That means buying mortgage bonds, artificially setting these markets with their money. They can influence the markets. They can't set the markets, but they can send a ungodly amount of money to purchase these mortgage bonds and be the biggest holder and trader of these bonds. Then they can set the market if they have the biggest holdings. And that's what they did through COVID, which was needed, by the way. Good move by them. But they took it all the way into 2022. It wasn't needed by then. Their rationale was due to the low numbers on both core PCE and CPI, the two reports we talked about earlier. However, these numbers were being held artificially low due to the enormous waiting in shelter, which was reporting low numbers due to the aforementioned lag. Had they used a real-time look at shelter, they would have seen that inflation was already becoming problematic and would have moved more quickly to preempt the inflation that was about to come. Here is a look at the BLS and BE calculations on shelter that create the lag, right? So the calculations look at countries in 6 segments. They call them A through F. Each panel takes a turn in being used for government inflation calculations. Apparently, the BLS, this is Bureau of Labor Statistics. If you watch this update every week, you'll know my fire and fury with the inaccurate data they've been putting out, is not equipped to handle looking at all 6 segments each month. Crazy. So they get this data, they put millions of dollars behind these resources, and then they don't even look at all the data. It freaking blows my mind. Years ago, this type of real-time and reliable data from sources outside of the BLS may not have been available. Today, we should consider using this data since the BLS might not or may not have the ability to exponentially calculate this information. Let's take a look at an example, right? So in government A, the other 5 regions are ignored, right? So they look at just one panel per month. Then the following month, one of the other regions is calculated. The obvious problem is that next time we look at panel A, it's July, right? So we're looking at it twice a year instead of looking at it every month. That means that the change in rents, like significant decreases we've seen as of late, are not factored in the 6 months. To add insult to injury, the calculations also fail to contemplate that when A is surveyed for the amount of time being paid, it may be reflective of a lease that was signed several months earlier. That's the problem with the lag. And they're only looking at leases instead of home prices and mortgage payments. We estimate and Back testing data supports this, that the leg is approximately 1 year. This also explains why the government is looking at 4.6 and 4.8 shelter readings, meaning inflation is up in rents by 4.6 and 4.8%, when the real number is approximately 1.5. Now let's take a look this impact has, right? Here's the important part. Core PCE currently 2.8. Shelter components 18%. Government data shelter 4.8. Actual market data shelter is 1.5. This is what actual real time is. Overstatement of shelter 3.3%. If the actual shelter reading of 1.5% were used, the overall core PCE inflation is 2.2, very close to their target. Using this calculation on core CPI, the inflation reading would be 1.8%, below their target, already there, right? They don't need to pause rate cuts. They need to get aggressive. Otherwise, this is going to go too far. If both the Fed and the markets were looking at these readings, it would paint a completely different and more realistic picture on inflation. As a result, I believe the Fed will be looking to cut rates aggressively, and the bond market would improve significantly with mortgage rates closer to 6 than the 7 that they're currently at, with a little bit, closer to about higher 6s right now. It's come down a little bit, probably since he's wrote this letter to President Trump. So a simple change to more real-time methodology would solve the current problem and assist in preventing miscalculations. Your loyal friend, Barry Habib. So I love Barry. He's taught me so much about this business. If you look at this as a home buyer, this is what you want to have happen. But here's the problem. If you wait until this happens and rates comes down, that's what everyone else is doing. Then you come back in and home prices go because inventory has not caught up. Inventory has not caught up. So these are the reasons why it's so important to be aggressive now. I've said it many times. Find the home, marry the home, date the rate, divorce the rent, right? If you're renting. But people say, oh, well, you've been saying that for 2 years. Yes, and we've executed on it several times. It's just people don't act quickly when these rates, like right here, come up. You can see that lasted 2 hours on December 9th. That's it. That means you got to be ready and willing to act right away when you get a call from me after you buy to refinance. Now, half the people do, half the people don't. Half of the people that didn't act are kicking themselves now because rates haven't been anywhere near to that point over the last, it's going to be about 2 months. I think it will get back to there, and I'll be able to call all those people again. So I know this was a really long update, but I wanted to share this with you. I think it's so important to know what's coming. And this is no shot at the Fed. They've been doing, it is a little bit, but they've been doing it this way for too long. There is better data. There's real-time data out there. Thank you to MBS Highway for everything you do for us in the mortgage world. Thank you to Barry to being a proponent and an advisor to our new president to get housing more affordable. You heard him say this, right? You heard him say, I demand this. Now, hopefully he takes this information, is armed with it, and can go to the Fed and have a non-political conversation of why we need to change to more real-time data than the old flawed data models that they're using. So I will continue to keep you updated on this. We're here for your home search. Thank you for listening. I know this is long. If you have any extra questions about this or with your home search, give us a call, 312-731-4939.